A Limited acquired 1600 ordinary shares of rupees 100 each of B Limited on 1st July 2016. On 31st December 2016, the summarized balance sheets of the two companies were given. So as you can see, you have purchased 1600 shares. If I see the balance sheet of B Limited, shares are of 100 rupees each. So I just remove those two zeros at the end. That means there are 2000 shares in B. Out of 2000 shares, you have purchased 1600 shares. That means your percentage of holding is 80%. So I can say that A Limited, it has acquired 1600 shares out of 2000. That means we have acquired 80% shares of B Limited. If you have more than one half, obviously the other company has become your subsidiary. This time we have purchased the shares on 1st July. So 1st July 2016, that is our acquisition date. That acquisition date I now compare with the balance sheet date. Balance sheet is given on 31st December. So it seems that we are following the calendar year as the accounting year over here. You have purchased the shares on 31st December 2016. So this year must have started on 1st January 2016. So this time we have not purchased the shares at the beginning of the year. This time we have purchased shares during the year. Actually, the first 6 months came to an end on 30th June, and on the next day we have purchased the shares. So remember this for pre and post acquisition analysis. All the reserves that are existing on 1st July 2016, that will become pre-acquisition, and the reserves which are increasing after 1st July 2016, that will be considered to be post-acquisition. Okay. Let's study the balance sheets over here. Share capitals and reserves, profit and loss account, bank overdraft only in the parent, and the trade payables. Pretty regular liability side. Asset side, they are saying land and building, plant and machinery, investment in B Limited at cost, inventory, trade receivables, and cash. So very ordinary balance sheets are given to us. Yes. They are saying the profit and loss account of B Limited showed a credit balance of 30,000 on 1st January 2016. So at the beginning of the year, they have given us the P&L balance. And then they say that out of the opening balance, see this, look at the choice of the words. They are saying out of which a dividend of 10% was paid on 1st August. You are buying shares on 1st July. On 1st August, the subsidiary is paying dividend, but the subsidiary is not paying dividend for the current year. The subsidiary is paying dividend out of the opening balance. Now this opening balance is there on 1st January 2016. So if you are using opening balance, that means you are using the closing balance of the previous year. See, closing balance of the previous year will become the opening balance of the current year. Previous year is 2015. So you are paying dividend, the subsidiary is paying dividend for the year 2015. You are buying shares on 1st July. Dividend is paid on 1st August. So naturally, the parent company will receive dividend. But remember, once you are receiving dividend, accounting standard 13 will kick in. Accounting standard 13 says that, see, you receive dividend does not mean it's an income and you credit it to your P&L. No. If the dividend is for the period before you acquired the shares, which is so over here, if the opening balance of the P&L is utilized for payment of dividend, that means this dividend is of the previous year. So on 1st August 2016, you are receiving dividend for the year 2015. This dividend is for pre-acquisition period. Pre-acquisition dividend should be credited to investment account. Now what have they done? They are saying that A Limited credited the dividend received to its profit and loss account. You know, this is the natural tendency. The normal tendency is, even in the trial balance also, if you will see dividend received, you will like to credit it to the P&L, and that is what the parent has done. Remember, it is wrong. Pre-acquisition dividend is not an income. Pre-acquisition dividend is a recovery of cost. It should be credited to investment account. So the parent has committed a mistake. It has wrongly credited the P&L. We will have to rectify this mistake when we are preparing the consolidated financial statements. How will I correct the mistake? See, they have shown the investment in the books at 3,40,000. This 3,40,000 should be reduced by our share in the pre-acquisition dividend, because I will treat pre-acquisition dividend as a recovery of cost. Not only that, the dividend has been wrongly credited to the P&L of the parent. So from the P&L of the parent, the wrong credit should be eliminated. If a wrong credit is taken, that means I will have to debit it. As an accounting entry, if you see this as an accounting entry, the accounting entry that we are proposing is profit and loss account debit to investment account. This is the rectification accounting entry that you can record. You have wrongly credited the P&L, so I should now debit the P&L. And the right treatment is to credit the investment, so I'm crediting the investment. Ask yourself, where will you consider the investment? Where shall you consider investment? Investment in shares of subsidiary is considered in cost of control calculation. When you work out the goodwill capital reserve, you consider the cost of investment. So at that time, we should credit the dividend, right? So we will deduct the dividend, not the entire dividend, the dividend that you have received as a parent. So that is giving the right effect, crediting the investment account. And where else is the dividend lying? It is lying in the P&L of the parent. So from the P&L of the parent, we will remove the dividend. Tell me, when will you consider the P&L of the parent? Every working note that we do for consolidation, we consider the figures of the subsidiary, except the last working note when we calculate the consolidated reserves. When you calculate the consolidated reserves, we consider the closing balance of the parent. At that time, we will rectify this mistake. This is, of course, discussing it orally right now. When we will solve the question, I will discuss this point even greater. Okay, what more is there? After the P&L and all, they are saying the plant and machinery which stood at 1,50,000 on 1st January 2016 is considered as worth 1,80,000 on 1st July. So the day when you are acquiring shares of the subsidiary, we are doing a revaluation of the plant and machinery. They are themselves now clarifying that this figure is to be considered while consolidating the balance sheets. So indirectly, they are trying to tell us that the effect of the revaluation is still pending. And then they clarify that the rate of depreciation on plant and machinery is 10%. Prepare consolidated balance sheet as on 31st December 2016. Yes. We ought to carry out the necessary working notes now. This is the first thing that you can really put in your books, the holding structure. 80% shares in B Limited on 1st July 2016. Don't forget that, 1st July 2016. Okay, I'm just removing it now so that we can carry out our workings. So let's prepare our working notes. Recall the principles of consolidation. Principles of consolidation. The first one, line by line addition. That we will apply the last when we will ultimately prepare the consolidated balance sheet. The second working note, which is the main working note, is the pre and post acquisition analysis. That is the second principle of the consolidation. We have to carry out pre and post acquisition analysis of the subsidiary. This time the acquisition date is 1st July. So I will require the figures on 1st July and after 1st July. So first we will have to figure out what are the change in the reserves and the P&L. Then there is some effect of revaluation also which is needed to be given, and then we will apply the second principle, I mean a working note for the second principle, the pre and post acquisition analysis. Let's do the first one. We will like to know increase in reserves and surplus of B Limited in 2016. Okay. We prepare columns for reserves profit and loss account. I will say balance on 31st December 16. Check the balance sheet. 1,82,000. 1,82,000. This time there is a point of dividend. Now this closing balance that we have in the P&L obviously will be after paying the dividend. So we will add back the dividend. We'll say dividend at the rate 10% for 2015. Right, the dividend has been paid for the year 2015, 10%. Yes, dividend at the rate 10%. The share capital is 2 lakhs of rupees. So I say 2 lakhs into 10%, 20,000. Let's take a total. And then we say less balance on 1st January 16. We are buying shares on 1st July, but they are not giving us the opening balances on 1st July. They are giving us the balances on 1st January 2016. Right? So they are saying that the P&L of B Limited showed a credit balance of 30,000. They are not giving us what was the balance of reserves on 1st January 2016. When no balance is given, we will assume that the opening balance and the closing balance is the same, right? See, they should have given us that on 1st January 2016, what is the balance in the reserves? But they have not given us that balance. So I'm assuming that whatever were the reserves at the end of the year, same was the reserve even at the beginning of the year. Perhaps that is the reason that they have not given us the reserve information. So I'll put over here 1 lakh. Here 30,000 is given. That means there is no change in the reserves during the year. Here the reserves have changed by 72,000. Right, we put our assumption, we say assumed no change in reserves because opening balance is not given. Right, they have not given us the opening balance. We assume that there is no movement in the reserves. So there is one extra point this time about the dividend. So dividend for 2015, we are adding it back. Why? Because you have already paid the dividend. If you have already paid the dividend, it must have been debited to the P&L. So 82,000, which is the closing balance of the P&L, must be after payment of dividend. So that is the reason I'm adding back the dividend. Since you add back the dividend, we get the balance is 1 lakh 2, opening balance is 30. That means the profit that has been earned during the year is 72,000. In case if you are wondering that why the dividend is added back, what difference will it really make whether we add the dividend or we do not add the dividend? It will make a lot of difference. See, understand, you are ultimately, why are we doing these workings? Because ultimately we want to do pre and post acquisition analysis, right? So it is very much necessary that whatever dividend that has been declared by the subsidiary is added back, so that later on we can decide whether this dividend is out of pre-acquisition profits or whether this dividend is out of post-acquisition profits. Remember one thing, The date on which dividend is paid is not important. Okay, the date on which dividend is paid is not important. The period for which the dividend is paid, that is important. When did you pay dividend? Dividend is paid on 1st August 2016. For what period? Okay, for what period dividend is paid? For the year 2015, right? For the year 2015. When was the dividend paid is not important. The treatment of the dividend will be decided by whether it is pre-acquisition, post-acquisition. So the year for which the dividend is paid is important. So first reverse back the dividend. Later on, we will decide whether the source of the dividend was pre-acquisition profits or whether the source of the dividend is post-acquisition profits. This is the reason that we are adding back the dividend. Okay, great. We do have a point of revaluation. I will like to give the effect of the point of revaluation now. So I say as a second working note, revaluation effect. Right, it is plant and machinery that is getting revalued. So I prepare a column. Only one asset is changing in value, the plant and machinery. Let's read the information. They are saying the plant and machinery which stood at 1,50,000 on 1st January 2016 is considered as worth 1,80,000 on 1st July. You are doing revaluation on 1st July. Remember this. The book value and the revaluation date both should be on the same day. Only then they are comparable. See, they are giving you 1,50,000, but 1,50,000 is on 1st Jan 2016, while 1,80,000 is on 1st July. I can't compare 1,50,000 with 1,80,000. Book value is on 1st January, while the revaluation is on 1st July. I require book value also on the date of revaluation, which is 1st July. So that's how the effect will be given over here. We say book value on 1st January 2016. It is 1,50,000. I want to reach up to 1st July because 1st July I'm doing the revaluation. So I will deduct depreciation for 6 months. So I say less depreciation for 6 months. It will be 1,50,000. Rate is 10% into 6 by 12. So that turns out to be 7,500. So I get 142,500. 142,500. Tell me, what is 142,500? 142,500 is book value on 1st July 2016. And now below that I say revalued at on 1st July 2016. 1st July 2016. Yes, 1st July 2016, you have revalued at 1,80,000. 1,80,000. What's the difference? 37,500. This is upward revaluation. You can even use the word revaluation gain. Upward revaluation on 1st July 2016. So we have carried out an upward revaluation. 37,500. If you have not given the effect of revaluation, that means you have also not given the effect of that depreciation. Yes. Say depreciation effect for 1st July 2016 to 31st December 2016. Isn't it? We say depreciation on revalued amount. Once you carry out the revaluation, the prospective depreciation will be on the revalued amount. The revalued amount is 1 lakh 80, rate is 10% into 6 by 12. Basically, it is 1 lakh 80 into 5%. So the depreciation on the revalued amount is 9,000. And then we say less depreciation already provided. Depreciation already provided. See, your book value is 1,50,000 and the depreciation for the first 6 months is turning out to be 7,500. That is, for the next 6 months also, the depreciation will be 7,500. Or you can show the calculation again. It is 1,50,000 into 10% into 6 by 12. Depreciation will be continued to be determined on the opening book value. Please, I've seen a lot of students commit this mistake. Don't take this figure and charge depreciation again. Depreciation will be not charged every 6 months. Depreciation will be charged only at the end of the year. That's it. So at the end of the year, you must have charged depreciation on 1,50,000. Okay. So total 15,000 depreciation must have been charged. 7,500 for the first 6 months, 7,500 for the next 6 months. So based on this, we are getting 1,500. You should have provided 9,000, but you have provided only 7,500. So additional depreciation of 1,500 is to be provided. So depreciation to be provided. I need to make a provision of 1,500 of depreciation. Hope you are comfortable with the working. And now it is time to apply the very first principle. Yes, the very first the second principle of consolidation. The first one is line to line addition that I will do, and I will prepare the final balance sheet. Yes. This was 82,000. Okay. So one of our main workings, we say pre and post acquisition analysis of S Limited. Yes, I'll say here on 1st July 2016. And here I say after 1st July 2016. This time only profit and loss account is changing. Reserve has remained the same. Opening, closing is the same. So I prepare columns for 1st July 2016 and after 1st July 2016. Yes, we start with equity share capital. It is 2 lakhs. Then I say reserves. Reserves on 1st January 2016 is 1 lakh, 1st July also 1 lakh, and 31st December also 1 lakh, right? There is no change in the reserves. So I put it directly 1 lakh. And now, profit and loss account. This is going to be interesting. Profit and loss account. Understand it. Although you are buying shares on 1st July, they have not given you the balances of the P&L on 1st July. They have given you the balance of the P&L on 1st January. It's going to be very interesting. Please understand this. See, here it is, the balance on 1st Jan. The balance on 1st January is 30,000. But then my column title is not 1st January. My column title is 1st July. So I have to work out what will be the P&L balance on 1st July 2016. Now, during 2016, the profit that you have earned is 72,000. This 72,000 is earned from 1st January till 31st December. But I am buying shares exactly in the middle of the year on 1st July. We will assume that this profit has been earned uniformly throughout the year. So 72,000 is made in the entire year 2016, right? Entire year 2016. So I will allocate this profit first 6 months and the last 6 months. So the way I do it is, I'll just show in brackets. See, on 1st January, it is 30,000 plus 72,000 into 6 by 12. I hope you are comfortable with it. See, I want balance on 1st July, but this 30,000 is not balance on 1st July. This balance is on 1st January 16. So from 1st January 16, understand this. From 1st January 16, I have to reach 1st July 16. On 1st January, the balance is 30,000. Question is how much profit I must have earned up to 1st July. Now, in the entire year, you have earned 72,000. In the entire year, 72,000. So, in the first 6 months, we are assuming that the profit was earned uniformly. So, if in the whole year you have earned 72, then up to 1st July, how much? Up to 1st July, it will be half of 72, which is 36. That is what I am showing over here as 72,000 into 6 by 12, 36, and this 30. So 66,000 rupees over here, right? And here also on after 1st July, I'll say it will be 72,000 into the last 6 months. So that will turn out to be 36,000. All these things we have to do because you are buying shares during the year. In the previous question, we did not do this, right? In previous question, we did not do this because you are buying shares at the beginning of the year. Balance is also at the beginning of the year. Here you buy shares during the year, but balance is at the beginning of the year. So I have to go 6 months forward, and this is the adjustment that I need to carry out. What more? To this, I'll have to now give effect of the revaluation. Okay, I'll have to give effect of the revaluation. We have done revaluation of the plant and machinery. So we say upward revaluation. And remember, revaluation is done on 1st July 16, right? If you see the working note of the revaluation, here it is. Remember this thing, I'm just showing it you once, and then I'll put it directly in the working note. See, you have done upward revaluation of 37,500. You have done the revaluation on 1st July. So put it under the column of 1st July. 1,500 rupees of depreciation is to be provided, but it is to be provided for 1st July to 31st December. That means after 1st July. After 1st July, it will affect my post-acquisition profits. So revaluation is done the day you buy shares, so pre-acquisition. But the effect of the depreciation is after you have done the revaluation. So it will affect my post-acquisition profits. So I'm saying here, upward revaluation on 1st July, yes, 37,500. And then we say depreciation to be provided. It is to be provided for the period after we acquired the shares, 1,500, right? So 1,500 will be debited to the P&L. It's the additional depreciation to be provided. That's the reason. Let's take an intermittent total right now. It's 4,03,500. This is still not the final total. 34,500. What is left? You have to now give the effect of the dividend that has been distributed. See, we are calculating net assets. Net assets means assets minus liabilities, which here we are doing as a balance sheet equation, that assets minus liability is nothing but share capital plus reserves and surplus. But remember one thing, if you are paying dividend, then dividend will be paid in cash. And if you are paying in cash, it will reduce your net assets. So effect of dividend needs to be given now. So we say here dividend, okay, dividend for 2015. We know that the subsidiary has paid a dividend of 20,000 rupees. And we know that the dividend is for 2015. 2015. Dividend is for pre-acquisition period. This first column that you are having, 1st July 2016, it is keeping a track of pre-acquisition, right? That's the reason. Effect should be given in the pre-acquisition column. So dividend which has been paid, I will deduct. The dividend paid will result into reduction in the cash and bank balance. Reduction in cash and bank balance is reduction in the net assets. So I get this final figure now, 383,500, and here 34,500. I hope you are okay with the dividend effect. Again, I'll repeat in case if you have some trouble. Otherwise, you can just move forward and see the video further. What we are arguing is that dividend is for the year 2015. Right? Dividend is for the year 2015. So it will be paid out of profits earned in 2015. Profit earned up to 1st July 2016 is pre-acquisition. So obviously the profit earned in 2015 will be also pre-acquisition. And that's the reason we are giving effect in the pre-acquisition profits. So very well, we have been able to do the working for the pre and post acquisition analysis, which is the second principle of consolidation. Okay. The third principle now, cancel the investment in the equity shares. That's your working for cost of control, right? Cost of control. We say here cost of shares on 1st July 2016. We have purchased the shares for 3,40,000. We have received dividend from the subsidiary, which we have wrongly credited to the P&L. It is a recovery of cost, so deduct it now. We say less pre-acquisition period dividend, right? Dividend needs to be deducted. The dividend paid is 20,000. Don't deduct 20,000. We will not receive entire 20,000. We have purchased only 80% shares. So we will receive 16,000. So I get 3,24,000. 3,24,000. Then we say less share in net assets, on 1st July 2016, right? You acquired the shares on 1st July. My net assets should also be on 1st July. 383,500. Here it is, right? This figure that we have already calculated, it is on 1st July into 80%. Into 80%. 3,06,800. I'm getting 17,200. We paid 17,200 extra goodwill. Goodwill of 7,200. Next principle is to get the minority interest. We say share in total net assets, right? Total net assets. 383,500 plus 34,500 into 20%. 83,600. That's your minority interest. And now the final principle, consolidated reserves, right? Consolidated reserves and surplus. I prepare a column for reserves, profit and loss account. This is the place where we finally consider the profit of the parent. Balance of A Limited on 31st December 2016. Take the question, 2,40,000, 57,200. 2,40,000, 57,200. To this we say add share from subsidiary. We aren't getting any share from the reserves, but yes, we do have this 34,500. So 34,500 into 80%. 34,500 into 80%. 27,600. And hey, you have taken a wrong credit of the dividend to your P&L. Rectify that. So dividend wrongly credited. We have already calculated that, right? When we calculated the cost of control, we have already worked out that figure, 16,000. So wrong credit of 16,000 is considered. So we will be putting that figure here now. 16,000. So we'll get the final figures to be shown in our balance sheet. This is 2,40,000. $68,800. So principle number 2, 3, 4, and 5 of consolidation taken care of. Cancellation of investment, principle number, pre and post acquisition analysis, that's principle number 2. Cost of the investment getting cancelled and the resultant goodwill capital reserve, that is the third principle. Minority interest, fourth principle. Consolidated reserves, the fifth principle. Now it is time to apply the very first principle, line by line addition. Okay, so here it is. These are the figures that will be ultimately be incorporated by us. Let's prepare the consolidated balance sheet. Consolidated balance sheet of A Limited as on 31st December 2016. We put our broadheads. Shareholders' funds. Share capital. Reserves and surplus. The balance sheet is of A Limited, so put the share capital of A Limited, 5 lakhs. For reserves and surplus, you can prepare a separate note, but I'm showing it over here itself. Reserves, profit and loss account. Your workings, 2,40,000, this is 68,800. Fine. And 2,40,000, isn't it? 2,40,000, 68,800. The second head is minority interest. From the working again, minority interest. Here it is, 83,600. My third head, non-current liabilities, not given. And the final head, current liabilities. They have given us bank overdraft. Okay, you can prepare a separate note, but again, I like to show it here itself. Short-term borrowings, 80,000. Trade payables. Trade payables, finally the time to do line by line addition. 47,100 plus 17,400. 64,500. 64,500. I can get the total now. $1036,900. Below that, assets. If you are still writing the liability side, you can just pause the video and complete it. Time for the assets, right below this only. But for simplicity, I'm putting it over here so that I can study the asset side and guide you accordingly. Assets, your first head, non-current assets. Under non-current assets, we say A, property, plant and equipment, basically tangible fixed assets. If you see the balance sheet, they have given you land and building and then plant and machinery. You should prepare a note, but I show it over here itself. I say land and buildings, yes. do a line by line addition. There is no adjustment for land and building. So I just do a line by line addition, 3,30,000. Second item, plant and machinery. Okay, let me show it. Here also first line by line addition. First do line by line addition. 2,40,000 plus 1,35,000. But we have done upward revaluation of 37,500 and we have provided additional depreciation of 1,500. 4,11,000. 4,11,000. Time to show the intangible assets. Under that, I'll show goodwill. I believe it is 17,200. Check the working. Goodwill. The cost of control working. Here it is. It is indeed 17,200 of goodwill. Yeah, then I look at the asset. They have given me investment in B Limited at cost. This is cancelled by us, and that's how we got the result in goodwill of 17,200. So no need to be shown over here. Right, so that takes us to the current assets. The second head, current assets. No adjustment is there over here. So I say here, inventories, please do line by line addition. 156,400. Trade receivables, line by line addition, right? Line by line addition. 99,800 is the total that I'm getting. And finally, cash and cash equivalents. Again, line by line addition. 22,500. Let's take a total. Total 1036,900. That's your complete asset side. This only na liability side, how much was it? Yes, 1036,900. Again, in a very logical manner, I've explained you how this question is to be solved. Logical, right? Step by step, you have to build the working notes for consolidation. Consolidated balance sheet is itself very simple. It's very simple, line by line addition. That's most of the work. But I have to put in this balance sheet the figures relating to the assets after the adjustment. I have to put in this balance sheet minority interest, the consolidated reserves and surpluses, and of course the resultant goodwill or capital reserve on cancellation of the investment. So those are the main workings, right? And that you can very well do if you have done the principles of consolidation well. I've told this earlier also, but again I'll request you, if you have not watched the episode of mine on 5 principles of consolidation, you are requested to watch it and then you approach this question. Another thing, this is your study material question. compare my working notes with the working notes of the study module, you will realize that it is much, much simpler, more lucid, simple to understand, logical. Because it's logical, it will fit into your brain. Step by step, you will be able to understand how the balance sheet is to be prepared.